Hello, friends. If you are 65 or older and you have ever given money, stock, or help with bills to an adult child or grandchild, there's a number I need you to hold for the next 20 minutes. That number is $230,000. That is how much avoidable taxable gain one family nearly handed their heirs with a single generous gift. The IRS trap in the title is real, but it is the smallest problem. Behind it sits a Medicaid penalty, a basis rule most families have never heard of, and a benefit system that treats your generosity as a violation. None of these systems warn you, none of them talk to each other, and not one of them cares that you meant well. Hello, friends. Here's the first thing you need to know that the hook did not cover. The number most people call the gift tax limit is not actually a tax line for the vast majority of Americans. It is a filing line. And that confusion, that one wrong assumption, is the first domino in a chain that can reach into Medicaid, into your heirs' tax basis, and into benefit programs that have nothing to do with the IRS. Grab a pen. This video has 5 sections. Mark the ones that apply to you because at least one of them will. And this is not just about writing a check. It is also about deeds, stock accounts, loan forgiveness, and paying someone's bills the wrong way. The exclusion amounts change. The state Medicaid rates move every year, the benefit thresholds shift, and no agency, not the IRS, not Medicaid, not Social Security, calls you when the dangerous number changes. The people subscribed to this channel find out in time. Subscribe now and let's get into it. Before we go further, I need to address something, because people hear a video about gifting and immediately sort themselves into one of 2 groups. The first group is comfortable, some savings, maybe a paid-off home, possibly some investments. And they figure gift tax problems are only for people with multi-million-dollar estates. The second group is on a fixed income, counting every dollar, and they have already decided they do not have enough left for gifting mistakes to even matter. Both of those assumptions are wrong about at least one section in this video, and on every single one, I will tell you exactly which group it helps most and why. The comfortable group is going to get a surprise in the section about basis. The fixed income group is going to get a surprise in the section about Medicaid. And stay with me because the last section is the one you can actually use before you write a check, add a child to a deed, or move a single share of stock. Section 1. The IRS trap most seniors get wrong. Here is the misconception. Most people believe that if a gift is under the limit, nothing needs to be reported. That is wrong. In 2026, the annual gift tax exclusion is $19,000 per recipient. If you are married and both spouses agree to split gifts, you can shelter $38,000 to one person. Go over that line, and the IRS expects a Form 709, United States Gift and Generation Skipping Transfer Tax Return. That form is due April 15, 2027, for any reportable 2026 gift. Now here's the part that trips people up. Filing the form does not usually mean you owe tax, not even close. The federal government gives you a lifetime basic exclusion amount of $15 million in 2026. So if you wrote a $50,000 check to one child this year, you subtract the $19,000 annual exclusion, and the remaining $31,000 is the taxable gift amount. For most viewers, the immediate tax bill on that is zero, because the $31,000 just chips away at your $15 million lifetime shield. But the Form 709 filing is real, and skipping it does not make the gift invisible. It makes the paperwork worse later, for your estate, for your records, and for every system that asks about transfers. This section helps both groups. If you are on a fixed income and you stretch to help a child with one large gift, the filing still applies. If you are comfortable and you assume gift tax rules are only for the ultra-wealthy, the paperwork requirement starts at $19,000. Not $19 million. Here is your action step. List every 2026 transfer by recipient and amount. Flag any single person who received more than $19,000. Then go to irs.gov/form 709. The deadline is April 15, 2027. That is section 1. And that IRS form is the smaller problem. The next section is the one that can leave a family paying for care with money they already gave away. Section 2. The 5-year Medicaid clock. The misconception here is dangerous. People think that if the IRS is not charging them tax on the gift is harmless. It is not. Medicaid long-term care, the program that covers nursing home costs and certain home and community-based services, has a transfer of assets look-back period. At the federal level, that window is 60 months, 5 full years. If you gave away money or property for less than fair market value inside that window, and you later apply for Medicaid long-term care, the state can impose a penalty period. During that penalty, Medicaid does not pay for your care. The penalty does not start when you made the gift. It starts when you are otherwise eligible for Medicaid long-term care, meaning right when you need it most. Let me show you what this looks like. Consider a retiree named Leonard. He is 79, lives outside Green Bay, Wisconsin, retired tool and die maker. His daughter went through a divorce, and he gave her $50,000 to help her get back on her feet. A year later, his health collapsed, and the family applied for nursing home Medicaid. That $50,000 gift sat inside the 60-month lookback. Wisconsin's 2026 daily nursing home rate for divestment calculations is $352.06. Divide $50,000 by $352.06, and you get 142 days. That is the penalty. For 142 days, Medicaid will not pay for Leonard's nursing home care, even though he is otherwise eligible. At $352.06 per day, that is $49,992 of care the family has to cover on its own. The entire gift came back as uncovered costs. This section helps the fixed income group most. If you think you have too little for gifting mistakes to matter, this is the section that proves otherwise. The transfer penalty hits hardest when the money is already gone and the care need is already here. Your action step: pull 60 months of bank records, checks, deed changes, loan forgiveness, and any large transfers. Contact your state Medicaid agency through the directory at medicaid.gov. Use these exact words: I need a transfer of assets review for the last 60 months, and I need to know whether any gifts create a long-term care penalty in my state. That is section 2. Now, the most human response to everything I just said is this: I was only trying to help. So let's deal with the ways people try to help, and the one route that does not create the same trap. Section 3. The human reasons people do this, and the one right route. The misconception is simple. People assume that helping with tuition, medical bills, or a grandchild's expenses works the same way no matter how you send the money. It does not. The IRS recognizes 2 specific exclusions that operate outside the $19,000 annual gift limit entirely. If you pay tuition directly to a qualifying educational institution, not to the student, not to the parent, directly to the school, that payment is excluded from gift tax. You do not even report it on Form 709. The same rule applies to medical expenses paid directly to the provider, direct to the hospital, direct to the doctor's office. But here is where the route matters. If you write the check to your grandchild and they pay the school, you just made a gift. If you pay room and board, that is a gift. Books and supplies, a gift. And contributions to a 529 plan do not qualify for this direct payment exclusion. They fall under the regular annual exclusion rules. Now, if you are married, proper gift splitting lets you shelter $38,000 per recipient in 2026 through the annual exclusion. But the direct pay route can move far more, because it is a separate rule with no stated dollar cap, as long as you pay the institution or provider directly. One more thing. If you gift assets to a grandchild and those assets throw off investment income, be aware of a rule called the kitty tax. This is not a tax on the gift itself. It is a tax rule that can apply to the unearned income generated by gifted assets. In 2026, if a covered child or full-time student has unearned income above $2,700, the excess may be taxed at the parent's rate using Form 8615. The kitty tax applies to children under 18, and in certain cases to 18-year-olds and full-time students aged 19 to under 24. This section helps both groups. The direct pay route is available whether you are comfortable or stretching to help. Your action step. If you are helping with school or medical costs, call the billing office and ask one question. Can I pay this tuition or medical bill directly to the institution or provider so it stays under the direct payment exclusion? Then verify the route against the Form 709 instructions at irs.gov. That is Section 3. Up to this point, this sounds like a paperwork problem and a Medicaid problem. It is bigger than that. The next section is where one generous transfer can create a tax problem your family never needed. Section 4. The household calculation, where the real money disappears. I need you to hear this one carefully because this section changes what you thought this video was about. Everything so far has been about filing requirements and government penalties. This section is about the tax bill your heirs will carry for the rest of their lives because of one well-meaning gift. When you give someone an appreciated asset, stock, a mutual fund, a piece of land, a rental property during your lifetime, they generally take your original cost basis. That is called carryover basis. Whatever you paid for it, or close to it, becomes their starting point for calculating gain when they sell. But if you hold that same asset until death, something different happens. Your heirs generally receive a basis equal to the fair market value on the date of death. The built-in gain is wiped clean. A woman I heard from was about to do exactly this. Call her Doris. She is 74, lives outside Phoenix, retired bookkeeper. She wanted to gift her son a mutual fund account worth $250,000. Her original basis in it was about $20,000. If she gifts it now, her son generally takes the $20,000 basis. The day he sells, he is looking at $230,000 of taxable gain. If she holds it until death, her son's basis is generally $250,000. Built-in gain on day one, zero. That is $230,000 of avoidable taxable gain exposure, on the wrong side of one emotional decision. This is where the comfortable group needs to pay attention. If you own appreciated stock, land, a low-basis home interest, or rental property, this section is for you. The biggest hidden dollar damage in this entire video does not come from the IRS form. It does not come from the Medicaid penalty. It comes from giving up the basis reset that your heirs would have received if you had simply waited. And there is one more layer. If you are on SSI, Supplemental Security Income, which is not the same as regular Social Security retirement, cash gifts from family count as unearned income. The first $20 per month is excluded. Everything above that reduces your federal SSI payment, which in 2026 is $994 per month for an individual. And if you give away your own resources or sell them below fair market value, you could face up to 36 months of SSI ineligibility. The resource limits are tight. $2,000 for an individual, $3,000 for a couple. Nobody in this system sends you a warning before the basis resets or the benefit check drops. The IRS does not file your Form 709. Medicaid does not waive the penalty because you are being generous. SSI does not pretend cash from a relative is invisible. Your action step. For any appreciated asset, get a basis comparison before you transfer anything. Go to IRS Publication 551 at irs.gov. If SSI is involved for either you or the recipient, call Social Security at 1-800-772-1213. The exact words, "Show me the current basis, the unrealized gain, and what basis my child would likely take if I gift this now instead of leaving it at death." That is Section 4. So the question is no longer whether gifting can backfire. It can. The last section is the framework that tells you when to wait, when to pay directly, and when to stop and get the numbers first. Section 5. The 5-question framework before you move a dollar. Here is the last misconception, and it is the most common one of all. People believe that any transfer that feels fair inside the family is safe enough, that if nobody is being greedy and nobody is hiding anything, the gift is fine. It is not fine automatically. And the reason it is not fine is that the systems I have been walking you through do not talk to each other. The IRS does not check with Medicaid. Medicaid does not check with SSI. Your tax preparer may not know your long-term care plan. Your elder law attorney may not know your cost basis. And nobody, not one of these agencies, is funded to sit you down and say, before you write that check, here are the 4 things that could go wrong. So here is the framework. 5 questions. Before you move a dollar, a stock share, a property interest, or add a name to a deed, run through all 5. Question 1. Is the gift to any single person more than $19,000 in 2026? If yes, you likely have a Form 709 filing requirement by April 15, 2027, even if no tax is due. Question 2. Is there any chance you or your spouse may need nursing home care or home and community-based long-term care Medicaid within the next 5 years? If the answer is yes, or even maybe, that gift sits inside the 60-month look-back window. Every dollar you transfer could come back as a penalty period when coverage matters most. Question 3. Is the asset you are giving away appreciated? Meaning, is it worth more now than what you paid for it? If yes, you may be handing your heirs a built-in taxable gain that the normal date-of-death basis rule would have erased. Pull the basis numbers before you decide. Question 4. Is anyone involved, you, your spouse, the person receiving the gift, on SSI or any other means-tested benefit program? If yes, the transfer can reduce benefits, trigger resource limit violations, or create up to 36 months of SSI ineligibility. Ordinary Social Security retirement benefits are not means tested in the same way, so keep that distinction clean. Question 5. Is there a direct pay route instead? If you are helping with tuition or medical bills, paying the school or provider directly avoids the gift tax annual exclusion entirely. That one routing decision can eliminate the Form 709 filing, preserve your lifetime exclusion, and keep the transfer out of the Medicaid lookback conversation for gift tax purposes, though the Medicaid treatment of direct payments depends on your state's rules. This section helps both groups equally. Whether you are gifting $5,000 or $500,000, the 5 questions are the same. The comfortable group needs questions 3 and 4 more than they expect. The fixed income group needs questions 2 and 5 more than they realize. Here is your action step, and it is the one that makes the whole video usable. Before you transfer anything, sit down with these 5 questions in front of you. Go to irs.gov/form 709 for the filing rules. Contact your state Medicaid agency through medicaid.gov for the lookback rules. Call Social Security at 1-800-772-1213 if SSI is involved, and say these words. Before I transfer this, I want to know the IRS filing effect, the Medicaid lookback effect, the basis effect, and the SSI effect. 1 pause. 4 questions to the right people. That is the framework. That is Section 5. So here is the full picture. Section 1. The $19,000 line that most people mistake for a tax line. It is a filing line. If any one person received more than $19,000 from you in 2026, check whether Form 709 is due by April 15, 2027. Section 2. The 5-year Medicaid clock. A gift inside the 60-month lookback can become a penalty period that blocks long-term care coverage right when you need it. Pull 60 months of records before any application. Section 3. The direct pay route for tuition and medical bills. Pay the school or the provider directly, and the transfer follows a completely different rule. No annual exclusion limit, no Form 709. Section 4. The $230,000 basis problem. Gift an appreciated asset now, and your heirs may carry a massive built-in gain that would have been wiped clean at death. And if SSI is in the picture, cash gifts reduce benefits, and resource transfers can trigger up to 36 months of ineligibility. Section 5. The 5-question framework. Before you move money, stock, or property interest, check the IRS filing line, the Medicaid window, the basis, the benefit exposure, and the direct pay option. 1 pause before the transfer. That is all it takes. Now here is what I need you to carry out of this video. The IRS does not file Form 709 for you. Medicaid does not ignore a gift because you meant well. SSI does not pretend cash from relatives is invisible. The tax code does not restore lost basis because the gift stayed in the family. Your state Medicaid agency does not call before the 5-year clock catches you, and no one in any of these systems is paid to sit you down and connect the dots across all 4 of them at once. Being generous and being protected are 2 different things. The gap between them is information and timing. Now I want you to think of one person, a parent, an aunt or uncle, a friend from church, a neighbor down the street, someone over 65 who has ever said the words, "I just want to help my kids while I am still here." That person is not careless. They are generous. And generosity is exactly what makes this trap so common, because the people most likely to get caught in it are the ones who would never think twice about helping their family. Send them this video, not because they are doing something wrong, because the rules do not reward good intentions, they reward information. And now you have it. Subscribe, share this with someone you care about who is thinking about gifting to their children or grandchildren, and I'll see you in the next one.